have, and as well as partnering with Cody. It's been great. So we kind of figured out that with Medicare and retirement planning, it probably goes hand in hand. So we figured that probably people can share some information on that. So and my name is Albert Moy. I'm with financial advisor with Edward Jones, and I'm glad to be here to share with you.
I'd like to thank all the chambers as well, the Chamber of Commerces that have helped co-sponsor this as well. So the Plymouth area chamber, the Cranberry Country Chamber, the Taunton area chamber, and the Cape Cod Canal region chamber. So I don't know. I guess I'll start with Plymouth. Meg, I don't know if you want to kind of introduce and say a few words about the Plymouth chamber.
Sure. So I'm Megan Doherty. I'm not going to take up too much time. I know we have a packed agenda, but I am the membership director for the Plymouth Area Chamber of Commerce. We are a regional chamber that covers Plymouth all the way up to Marshfield, and then we go as far as the Cape and Boston as well. Right now, we have about 750 members. We're extremely active. You can visit our website at plymouthchamber.com if you have any questions, or I will throw my email right in the chat. And I just want to thank Cody and Albert for doing this series today. We work very closely with Brabo, have a great relationship with them. So thank you for everything that you do for our members.
Thank you, Meg. I guess I'll go to the Cranberry Country. So I don't know if Pam or Valerie, if you guys want to.
Well, we're both here. It's good. Valerie Glenn with the Cranberry Country Chamber of Commerce, and I'm here with up because I just had a total knee replacement, so I'm looking a little bit peaked, but here and thankful that you're holding this nonetheless. And thank you, Cody. We have a lot of things going on. Just check our website, cranberrycountry.org. And Pam's here. She takes care of everything. She's the event lady and the marketing lady, and she's terrific. We're a great team.
All right, Marie, Cape Cod Canal. I don't know if you want to say something as well.
Yeah, hi, Maria Oliva from the Cape Cod Canal Region Chamber. I'm the president and CEO. We cover Bourne, Sandwich, Wareham, also parts of Cape Cod and southeastern Massachusetts. So we're pretty much active regional chamber that works with our business members, especially during the pandemic. So we've really been working heartily for all our members so that we can learn about all kinds of programs that affect business. So thank you, Cody, and thank you, Albert. Well, I look forward to your program. Thank you.
Thank you. John Jagat, it looks like you're here for representing the Taunton Area Chamber. So I don't know if you, sorry to put you on the spot here, but I don't know if you want to say a few words. It looks like.
Sure. Hi, my name's John Jagat. I'm on the board of directors of the Taunton Chamber, and nobody told me I'd be representing them today. I'm here just for the great information that I'm hoping to get. And it's been great I think the Taunton Area Chamber of Commerce has got some new leadership. We've got a lot of good plans in the work. We've got some good energy. And so it's Taunton Area Chamber.org, I think. I'm not sure. Anyway, thank you. And I look forward to working with you guys and hearing what you have to say.
Thank you. All right, so I'm gonna share my screen here. Can you all see this document now?
Yes.
Yeah. Okay. All right, so Medicare. What is Medicare? Medicare is health insurance for anyone 65 or older, or anyone that's been on disability for at least 2 years. So part of Medicare is through the federal government. Part of it is through private insurance companies, and I think that's where a lot of people get kind of confused. So Medicare is not the same thing as Medicaid. It's completely different. That people confuse those a lot as well. Medicaid is more like mass health, people that need state assistance or financial assistance that way. So someone can be on Medicare and Medicaid, but they're different things. So I just want to start with that kind of distinction because I get asked that a lot as well. So Medicare. So the federal piece of Medicare is Part A and Part B of Medicare. So Part A of Medicare, well, for someone to sign up for the federal piece, they have to contact the Social Security Administration office, tell them that they want to sign up for Part A and B. Some people might only take Part A and they might opt out of Part B for now, but I'll cover that a little later as well. So the federal piece, Part A and B. So Part A of Medicare, the easiest way to think about it is anything where you're admitted as an inpatient in the hospital falls under Part A of Medicare. Part A, most people get for free, or they don't have to pay for once they're on Medicare because they've paid for it throughout their whole life, basically. So it's already paid for. As long as you've paid FICA taxes for at least 10 years, or they say 40 quarters. So as long as you've paid FICA and Medicare taxes through your paycheck for at least 10 years, you'll get Part A for free. Or if your spouse has paid taxes for at least 10 years, you'll both get Part A for free when it comes time for Medicare. Part B of Medicare does have a premium associated with it, or a cost. It's a month-to-month cost. And I'm gonna get into that in a minute. So Part B covers everything else outside of the hospital. So your normal primary care doctors, any specialist visits, any lab or blood work, anything outpatient surgeries all fall under Part B of Medicare. Part B does have a cost associated with it. And this is the rate chart for this year. So it's based on your tax return. It's based on the previous year's tax return that you filed, where you're really filing your income so they're looking at your income from 2 years ago, but they're looking at the tax return that you filed the previous year, where you're reporting your income from 2 years ago. So this first column is if you file as an individual. The second column is if you file as a couple. And this last column is what you would pay per person every month for Part B of Medicare. So this first row, the $148.50, that's the standard rate. That's what most people end up having to pay for Part B. Again, it's per person, but as you can see, the more money you make, the more the government makes you pay. And this is paid directly to the federal government, the federal entity of Medicare. So the most that anyone could pay this year is $504.90 for Part B. So A and B, as I said, that's the federal piece. The problem with A and B alone is that Part A has a $1,482 deductible for this year. So if someone had just the federal piece, had just A and B, and they went in the hospital for one night overnight, admitted as an inpatient, they would get a bill for almost $1,500 that they would be responsible to pay. And that deductible could reset every 60 days. So if they go in the hospital, they come out, they go back in 61 days later, they could get hit with that deductible again, up to 5 times in a year. Part B of Medicare only covers 80% of any type of medical treatment or anything medical related. And so the patient would be getting billed for the remaining 20% of everything because it only covers the 80%. So the other thing with A and B in the federal piece, there's no cap or maximum out of pocket. So that 80%, if someone had a really bad year, that 20% could just keep going up and up and up, and they could be left with pretty large medical bills by the end of the year. So the deductible, Part B also has a $203 deductible for this year. So what that means is that the person would have to pay the first $203 before Part B would kick in and cover the 80% of anything. So those deductibles and the 20% gap and some of the other gaps, those are the reasons that people would get private insurance, a private Medicare plan, because the private plans will offset some or all of the deductibles and the 20% co-insurance, and they add additional coverages that the federal piece alone doesn't have. So there's two different types of private Medicare plans. One of them is called a Medicare Supplement, and the other is called a Medicare Advantage plan. And then the Part D prescription plans, those are also through private insurance companies as well. So the main difference with the supplements, you can go to any doctor anywhere in the country that agrees to take Medicare, any doctor, any hospital. You're not restricted as far as networks. You have access to the national Medicare network. And with the supplements, they usually have higher monthly premiums, but other than that Part B deductible, the first $203, usually the supplements, depending on which type of supplement and which company you go with, usually you pay one flat rate every month. It's a month-to-month premium, and you don't have any bills. You don't pay any co-pays when you use the insurance. You could get like 10 surgeries in a month, but as long as you pay the monthly premium, you're not going to get billed most likely. As long as Medicare as the federal entity has to approve everything. So as long as everything is medically necessary and approved by federal Medicare, then you won't have any, you just have your monthly bill and it's like one flat rate, and you won't have to pay co-pays or bills most likely, other than the $203 Part B deductible. So the other thing with the supplements, they also don't have dental, vision, hearing, and a lot of additional coverages that some people do want, or that people are used to coming off of work insurance or group insurance. And then the supplements also don't have the prescription piece built into it. So you'd have to get a standalone Medicare Part D prescription piece. So on this side, it's what they call original Medicare. On that side, the government is your primary insurer. The government acts as the primary insurance company. So the other side, the Medicare Advantage, so I guess let me go back to this. So with original Medicare, so you could think of it, it's almost like three different plans that all coordinate and work together, because you could think of A and B as one plan. You're going to have one card, your Medicare card, that has A and B on it. You would have a second supplement card. So you would have to show the supplement card and the Medicare card when you use the insurance. And then you would have a third prescription card that you would show when you go to get your prescription. So it's like three separate plans that all work together. So the other side, the Medicare Advantage side, these plans are designed to mimic what people were used to with work insurance, and they function pretty similarly to how work group insurance has functioned. So basically the Advantage plans, they're also kind of the exact opposite of the supplements, where they do have networks of doctors. A lot of them are HMOs, some of them are PPOs, where they would give you coverage in or out of network, but all the Advantage plans have networks. So they're not as portable as the supplements if you go travel to different states and stuff like that. And with the Advantage plans, these do have, so basically the way they're paid for, a lot of them are much lower premiums. There's a number of plans that are $0 a month premium plans for the Advantage plan. So you still have to pay the Part B premium on either side, but there's no additional plan premium for a lot of the Advantage plans. And these are more pay as you use it. So instead of having the flat rate month-to-month cost, you wouldn't have that. You would have that for Part B, but you wouldn't have it for the additional plan. And you would just, when you go to use it, you would have co-pays and you would have potential co-insurance and you would get bills potentially. So it's paid for differently. So I think the easiest way to kind of think about it is the supplement side. You're paying up front every month. You might not use the insurance that month, but if you do use it, you know you're covered. You're most likely not going to have any bills or anything. And you're covered. You have the peace of mind that you're covered. For the Advantage plan, you're not paying the month-to-month cost, but you're paying it as you use it. And as I said, a lot of these plans have dental, vision, hearing, and a lot of additional benefits that the supplements don't have. And most of the Advantage plans also have the Part D prescription piece built into it as well. So that's it's yeah. So on this, so on the Advantage plan side, the private insurance company becomes the primary insurer, and the government basically passes the risk on to the private insurance company, and they say, okay, we as the government aren't responsible. You as a private insurance company are agreeing to take this risk on. So if John Smith racks up $10 million of hospital bills, you as a private company have agreed to handle that. And it's basically a way for the government to kind of step away, like step back and step out of the picture. And these Advantage plans have gotten very popular recently over the past few years. So basically, it's very situational. There's pros and cons to both types of plans. And even with a married couple, sometimes it's what's right for one spouse. Like one spouse would be on the supplement side and the other spouse would be on the Advantage plan side. That's pretty common. It's really very situational. There's no one size fits all type plan. It really depends on the person's medical needs, how often they go to the doctor, if they foresee a lot of hospital stays and surgeries in the next year or so. So again, it's very, very situational. There's no one size fits all solution for Medicare or for health insurance in general. So that's basically how the pieces work and how they fit together. So the other thing, every October 15th to December 7th, every year, anyone that's on a Medicare plan, they call it annual election period or annual enrollment. And basically between that time period, October 15th to December 7th, anyone that's on either a supplement or an Advantage plan can go and kind of look at other options and decide to change for the following year. And it would take effect January 1st of the following year. So you're never really locked in for more than a year at a time. And then if you have certain life events, like if you move, if you get married, divorced, there's a number of other situations, usually the government will open up what they call a special enrollment period, where they'll allow you to change to a different plan if there is a better plan for your situation. But again, that has to be approved by the government, and I don't work for the government, so that's how that works. So these are probably two of the most common questions I get asked. What happens if I'm still working past 65, or what happens if my spouse is still working and we're being offered health insurance either through my work or through my spouse's work? So in this case, it depends on the size of the company. Technically, if the company has under 20 employees, you're not allowed to stay on the group plan past 65. But this was kind of a recent change with the law, so the past year or so. So a lot of companies and insurance carriers have not caught up with this yet. So a lot of people are still remaining on the group insurance, even with under 20 employees. But I think down the road, they're eventually going to kind of catch up and realize that, or kind of force people off the plans that way. But other than that, so if the company has over 20 employees, you definitely can stay on the group plan. A lot of times what I'll do, so with Medicare, I know I mentioned the deductibles for parts A and B, but other than that, there's not really, like, a lot of group plans nowadays will have like at least $2,000, $3,000, some have like $6,000 deductibles, and stuff like that. So a lot of times what I do, I will look at what they're being offered by their employer, and I can kind of do a side-by-side comparison of like, this is what you would have with your employer. These are potential options that you would have if you did go on to Medicare. So if anyone has any questions about that, definitely reach out to me. I don't charge any fees. It's 100% free to talk with me or work with me. I just answer questions about Medicare all day. So in the other case with a spouse, so a lot of times, sometimes one spouse might be working, or if they say there's like a 63-year-old spouse and then the other spouse is 65 and the 65-year-old spouse is retired. Technically, or sorry, let me rephrase that. So if the 65-year-old is still working and their spouse is 63 and younger, but they're on the first spouse's, the 65-year-old's work insurance, every company will allow, as long as the 65-year-old continues to work, they can come off the work plan and go on to Medicare, and they can leave their spouse that's younger can stay on the work plan. That is definitely a possibility, and is almost every company that I've seen has allowed that, as long as the 65-year-old continues to work. So that is another option. And a lot of times people with work insurance, they could come, if taking someone off, they might be on a 2-person plan, they might be on a family plan. So taking one of the spouses off usually cuts the cost for the work insurance in half, because they go either from a family plan or a 2-person plan to an individual plan. So the rates are a lot less for that. So that's basically how that works. Again, it's very situational, and it's hard to kind of make generalizations, because it definitely depends on the person and the company, what plans they're being offered by the company, and their health needs as well. So that's basically my piece about Medicare. If anyone has any questions about anything I just talked about, I would like to open it up for questions now, and then after the questions, we're going to jump into Albert's piece about the financial side of it.
So quick question, if I might ask, Cody. So I'm gonna be hitting 65 soon, in a couple of months. And I'm already on Social Security. But when do I go to the government website and actually like create my Medicare account? Can you do that anytime?
Yes, so you can do it 3 months before your birth month. You can apply for A and B. So I realized you just kind of reminded me too, because I mentioned that I was going to cover it and that I didn't cover it at the beginning. But so a lot of times people, if you're still working and you are being offered work insurance, a lot of people will choose to take Part A while they're still on their work insurance, because if they're basically if they're getting it for free, it doesn't cost them anything, and it doesn't really help that much. But some people do take A while they're still working, and then they wait, and then they take Part B when they do retire. And the other thing is, when you retire or when you come off a group health insurance, if you're continuing to work, that opens up an 8-month window where you can go and you can sign up for A and B within that 8 months without being penalized, because there are some penalties associated with Medicare, where if you don't sign up within, well, you know what I mean, if you don't sign up within a certain time period, they will penalize you, and the federal government, they'll basically charge you more every year for the plans and stuff like that. But again, if you have questions, it's hard to kind of generalize that, because that's very situational too. So if you do have questions about that, feel free to reach out to me, and I can talk to you about your situation.
Thank you.
So, you're welcome. Does anyone else have any other questions? You can put them in the chat, or you can unmute yourself. All right, if not, I'm gonna switch the host to Albert and let him go on his presentation. All right, Albert, I think you're the host now.
Okay.
So Albert, just keep an eye on the waiting room, because I had to let some people in while I was presenting as well, so it will pop up in the top of the screen.
Okay. All right. Can everyone see this slide? Okay. So what I'm going to do is I'm going to shut my camera off. That way it would prevent a lot of distractions. 1 second. Why is my screen paused? Oh, 1 second. Something's going wrong. All right, never mind.
We could see it when you, before I could see it. I don't know when you shared your screen.
Yeah. Trying to see. Oh, that's not it. Where is it? All right, here we go. Here we go. All right, I'll leave my camera on.
Yeah, we can see that.
All right. So good morning, everyone. It's great to be here with you. My name is Albert Moy, and I am the Edward Jones Financial Advisor. I became a financial advisor because I have a passion for investing and helping people meet their financial goals. One of the ways I do this is by helping local businesses, nonprofit organizations, and individuals set up a retirement plan, which provides employees and individuals like you with a great opportunity to save for retirement. Retirement is a key financial goal for many people and can mean different things to each person in this room. Maybe you want to travel, volunteer, work part-time, or go back to school. Whatever you decide, you need to be financially prepared. That's what I like to talk about today. How can you prepare financially for the retirement you envision? So we'll discuss why you need to save for retirement, why you need to start now, and how to save through your employer-sponsored plan if you are working for someone. I'll also touch on options for building your retirement savings outside your employer's plan, including traditional IRAs and Roth IRAs. Why save for retirement? Unfortunately, many people are facing retirement completely unprepared. Consider the following from the Employee Benefit Research Institute. 33% of workers aged 55 or older have less than $25,000 saved for their retirement, and 54% have less than $100,000. %67% of workers surveyed said they expect to work in retirement, but only 27% of retirees report earning income during retirement, meaning many have to depend on their savings. Many were forced to retire earlier than planned due to health or other reasons. Is $25,000 or even $100,000 enough to cover your years in retirement? Probably not. The average life expectancy. Consider that the average 65-year-old will spend almost 20 years in retirement. That's the average. About half of this group will spend more than 20 years in retirement. Additionally, a 65-year-old couple has a 50% chance that at least one spouse will reach age 90 and a 20% chance that one spouse will reach age 95. A survey by the Employee Benefit Research Institute found that nearly 40% of retirees said they expect to outlive their savings. The role of Social Security. Reaching retirement is a major goal for most people. And so is having enough income in retirement? While Social Security wasn't meant to be the sole source of income, it serves as a foundation for many people's retirement income plans. On average, Social Security provides about 40% of income in retirement, according to the Social Security Administration. And if you are curious about our take on long-term security of Social Security, please send Pam or myself or Cody an email, and I'll pass that report over to you. That said, it's a good idea to know the amount of income you're expected to receive from Social Security and the date you're eligible to receive it. You can view your estimated benefit statement online at www.ssa.gov. The website also features an online benefit estimator. the impact of inflation. Let me give you one more reason to save. That's inflation. Historically, the inflation rate has been around 3% per year. At that rate, the cost of goods and services will double about every 25 years. To put the impact of inflation into perspective, consider how prices have risen historically and how they could rise over a 25-year period. Assuming they grow at a historical rate, in this chart, consider the impact of inflation between 1982 and 2008. At that rate, monthly groceries that cost $142 in 1982 are estimated to cost more than $1,900 in 2033. Why save now? I hope I've given you some insights into why it's important to save for retirement. Now let's look at why you need to start saving now. If time works against you with inflation, you can make it work for you with compounding. The longer you contribute to retirement, the more time your earnings have the potential to grow and benefit from compounding. This table illustrates the amount you would have to save each month with pre-tax contributions to reach the same investment goal. The earlier you begin investing, the less you need to save each month. Of course, this is a hypothetical illustration and doesn't reflect a specific investment. To work effectively, compounding requires two things: reinvestment of earnings and time. That's why it's so important to start saving as early as possible. Waiting to start funding your retirement plan can be costly. Let's look at another hypothetical example. Michael is 30 years old. If he contributes $6,000 each year in his employer-sponsored plan, plus an additional $1,000 once he reaches age 50, assuming a 7% hypothetical rate of return, he will have $986,000 at age 65. If he waits just 3 years to start investing, his account value drops to $793,000. That's a difference of more than $193,000. If he waits 10 years, his account value is less than half of what it would have been at age 30, $471,000. Have I convinced you that it's important to save and it's important to save now? Let's talk about how to save. Well, there's different plans. Your employer's retirement plan is a great way to begin or continue saving for your retirement. It's important to contribute as much as you can, given the issues we've discussed earlier. On average, you need about 80% of your pre-retirement income in retirement. Of course, that number can vary depending on what your retirement may look like. How much can you contribute to your employer's sponsored plan? The maximum amount you can contribute to a 401k, 403b, 457b plan annually is lesser of $19,500 or 100% of your annual compensation. If you're age 50 or older, you can contribute an additional $6,500. Some employers offer a matching contribution as well. Please remember that these funds are designed for retirement. Typically, you must reach a triggering event, such as separating from service, before you can take a withdrawal. If you take a withdrawal prior to 59 and a half, you will be subject to a 10% early withdrawal penalty unless an exception applies. Note, 457 plans do not have a 10% penalty. And here are some other plans. The maximum contribution to your simple IRA is lesser of $13,500 or 100% of your annual compensation. And if you're age 50 or older, you can contribute an additional $3,000. Your employer may also contribute 2% to all eligible employees or match your contribution up to 3%. And like I said before, these funds are designed for retirement, same as well as the other plans. If you take a withdrawal prior to 59 and a half, you'll be subject to a 10% early withdrawal. If your account is less than 2 years old, the tax penalty is 25%. Saving for retirement through your employer plan offers important tax advantages. Contributions to your 401k, 403b, 457b, simple IRA have traditionally been pre-taxed. That means that each dollar you contribute reduces your taxable income for the current year. In addition, your contributions and earnings are tax deferred. You don't pay taxes on them until you withdraw the money. Before you think of your retirement plan contribution as yet another deduction from your paycheck, let's take a look at the impact of pre-tax contributions on your take-home pay. In this hypothetical illustration, Beth contributes $100 of her $2,000 biweekly gross pay to a retirement account. Because she is in the 28% tax bracket, her federal income tax is reduced by $28. Even though she contributed $100, the difference in her take-home pay is only $72. Some retirement plans offer a Roth 401k or Roth 403b option that has different tax advantages. In Roth accounts, you pay taxes before you contribute in exchange for tax-free withdrawals in retirement. Upon reaching a triggering event, you can withdraw your contributions tax-free since you have already paid taxes. Withdrawals of your earnings are tax-free if you have held the account for 5 years and you are at least 59 and a half years old. Making Roth contributions may make sense if you expect your taxes to go up in the future. If you already have significant pre-tax savings, or if you don't like the uncertainty of future tax rates, then the Roth IRA will be one of your one of the recommendations, I would say. And we'll discuss the IRAs a little later. Once you decide how much you're going to contribute and what type of account you're going to contribute to, it's time to make some investment selections. The right investments for you depend on many factors, such as your risk tolerance, life stage, and goals. Let's start with risk tolerance. Risk in the investment world is usually associated with volatility. The stock market never moves in a straight line. There are ups and downs. In general, the higher the potential return of an investment, the more volatility you must be willing to accept. By finding the right balance between the risk you're willing to accept and the return you anticipate receiving, you'll be in a better position to stick with your investment strategy regardless of what the market is doing. Another factor that can influence your investment choices is your life stage, meaning time horizon. Let's look at how your risk tolerance and life stage work together to identify your investment objective. Once you have determined your risk tolerance and investor life stage, you can check the appropriate boxes to identify your portfolio objective. For example, if you are in your early investing years and have a relatively high risk tolerance, you probably want investments with a growth focus. On the other hand, someone in the higher income and saving years with a low risk tolerance, you may prefer a portfolio balanced with a split of growth and income. Keep in mind that other factors also influence your portfolio objectives, such as your time horizon, income needs, and existing savings. Once you know your portfolio objective, you can select investments that fall into the appropriate categories and the appropriate amounts. Let's compare the growth focus versus balance toward income focus. These suggested percentage ranges can help you as you make your investment elections for those available. Your portfolio objective can change over time or because of life circumstances. So it's important to review your elections quarterly. Other options. Let's briefly touch on tax advantage options for building your retirement savings outside your employer's sponsored plan. One popular way to save is an individual retirement account or IRA. There are two types of IRAs, a traditional IRA and a Roth IRA. A traditional IRA is similar to a 401k, 403b, 457b, and simple IRA. Contributions may be tax deductible depending on your income level, plus any earnings growth is tax deferred. Taxes are due upon withdrawal, and withdrawals prior to 59.5 may be subject to a 10% IRS penalty. You can put your traditional IRAs in virtually any investments you choose: stocks, bonds, mutual funds, CDs, treasury bills, and others. You can contribute up to 100% of your earned income, or $6,000, to a traditional IRA each year, whichever is less. Those ages 50 and older can contribute an additional $1,000 per year for a total of $7,000. A Roth IRA is similar to the Roth deferrals 401k, 403b. Your contributions are after tax, and any earnings growth is tax-free, provided you have had your account for at least 5 years and don't start taking withdrawals until you're at least 59.5. As is the case with a traditional IRA, you can invest Roth IRA funds in almost any investments you choose. Be aware, however, that your eligibility to contribute depends on your income. The contribution limits for a Roth IRA are the same as those for a traditional IRA. And if you have money in an employer-sponsored plan from your last job, you have options you may consider. You can leave the money in the former employer's plan if it's permitted. You can move the money to a new employer's plan if one is available and rollovers are permitted. And 3, you can roll over the money to an IRA, or you can take cash out of the account subject to tax consequences. So those are the 4 options from a previous employer 401k. After you carefully reviewed your options and also consulted with your tax professional if appropriate, if you decide to roll over your employer retirement plan assets to an IRA, you can do so without paying any taxes or penalties. Your money continues to have the opportunity to grow with tax advantages, and you can make additional contributions. The appropriate type of IRA will depend on the type of money you are willing to roll over. Again, you should consult a financial advisor and a tax professional before making such a move. One important note about rollovers into a Roth IRA: although there are income restrictions for contributions to a Roth IRA, there are no income limits to roll over to a Roth IRA. Enrolling is easy. If you are interested in more information, please see me to schedule a one-on-one appointment. At this time, I would open up the floor for your questions.
Yeah, I have a question, and thank you both for really good presentations. My name's Mary McGuire. So I have a 401k that I'm maxed out on, which is great, but I took a loan from my 401k to pay off some credit card debt that we have, and I've been paying myself back regularly with every paycheck. So, but now I have a son who's getting married, and I'd like to contribute some money to his wedding. Can I, with a portion of that loan still outstanding, but me paying it back regularly, can I withdraw any money from my 401k to help pay for some of his wedding? I'm 62.
I think most 401k plans, they only allow one loan at a time. So if you've already taken out that one loan, if you haven't paid that back, they would not allow you to take out a second loan.
Okay. All right. Thank you.
You're welcome. Okay. Any other questions? All right. Okay. So before we close, I'd like to mention I'm certainly happy to help you with any of your financial needs outside of saving from your employer retirement plan. Just shoot Pam, or get my information from Pam or Cody, and then we can probably schedule something. My consultation is always free, so if you have any questions regarding whether you don't have a plan and want to start a plan, give me a call. Thank you so much.
Thank you, everyone. I have been recording this and I think I did it correctly, so I'll be able to send it out to everyone, and I'll include Albert's contact info and my contact info when I send that out as well. So thank you for attending, and thank you to the chambers for helping co-sponsor as well. Thank you, Albert.
Thank you.
Thanks, everybody.
Great, thank you.
Cody.
A lot of
Thank
information.
you.
Nice job.
Bye-bye.
Bye-bye.
Right, have a good day, everyone.
You too.